This is New York Fire Department Pension Fund Investment Meeting. Today is 10/17/12. It is 20 after 10. We're at the New York City Controller's Office, 1 Center Street, room 530, New York, New York. Could we have a roll call of trustees?
Ms. Janice Emery.
Present.
Mr. Larry Schloss.
Here.
Mr. Justin Hall.
Here.
Mr. Stephen Cassidy.
Mr. Slevin is Mr. Cassidy's proxy.
Mr. James Levin.
Here.
Mr. Robert Straub.
Here.
Mr. John Kelly.
Mr. Straub has Mr. Kelly's proxy until he arrives.
Mr. James McGowan.
Patrick Dunn has the proxy for James McGowan.
Mr. John Dunn.
Present.
Mr. James Lamonda.
Here.
Mr. Sean O'Connor.
Here.
Commissioner Douglas White.
Here.
Plenty full votes in a quorum. We can start the meeting.
We'll start with public agenda.
Okay. Does everybody have their August results?
Yep.
Yes?
Yes.
Excellent. August, as we all know, is old news. It's good news, but it's old news. So let's I'll skip the usual preamble. Things have gotten better. Things have gotten better because the ECB said we're all in, and the Fed said let's have QE3. So that was two of the risks floating around the markets. So the markets are going up, and everything is good. So that gets us to page 32. All the charts look good. Everything's in the right direction. Good, of course, being relative. So at the end of August, we're back up to $8.3 billion. Looks like the highest ever. Yeah, it might be the highest ever, and I think end of September is higher still, so we're moving in the right direction. If you quickly go to the asset allocation page, on page 36, is as of August, everything was pretty much in line with tips. We bought some tips subsequently, so we're back in balance on tips. We funded some bank loans. We don't have the right bank loan representation on this. It's sort of the army green color on the right-hand side of the page. Martin's going to work on that, but we'll get that to sort of look right. We basically have no more cash because we added 1% to tips and 0.5% to bank loans. So that's, again, we're back in balance everywhere. If you look on page 37, we're about 2/3 equity and 1/3 fixed income, which is about right. Again, it's all in the range. And then if you jump to page 42, on the far left-hand side, you can see we made about 1.5 points in the month of August, bringing our fiscal year to date, which is the third bar, up to about 2.5%. I think we made about 1.5% in September, so we're probably up 4.5% for the end of the first quarter. The biggest driver is probably equities. As you can see, the green is U.S. equities. That's the biggest driver. It's also our biggest asset allocation. So again, when the stock market goes up, as much as we've worked in diversification, it's still good for the system. And that's about it. I mean, again, the first quarter is going to be a good quarter, and October is a little more volatile, but still looking up, I think. So, again, 2 months into a fiscal year, there's not that much to report, especially when the results are up. So, Seema, you have any color on the equities, or no? No. Martin? Barry? Hmm? You want to say that again so she can put that in?
That would be no.
That would be no.
Yeah.
Yvonne?
No for me.
Okay. Any questions on August? Perfect. We like up months that are simple. So Barry wants to talk about the IPS for private equity. Do you have Stepstone?
Yep, I'm going to get them. Okay, so as Larry mentioned, we're going to talk today about the policy statement, which is on page 67 in the book. What we thought we would do would make the most sense is really just go over the changes. And the idea behind the changes in the policy statement were really threefold. One, to make some clarifications on some of the information that was out there.
Barry, what page you said?
67? That's 69. To make some clarifications on the previous policy statement with regard to some of the terms that were used to kind of give some more detailed definitions. Two, talk a little bit about the benchmark, and we have a couple of recommendations. And three, to just give a little bit more granularity about the overview of the portfolio, so when you review it on an ongoing basis, you just get a better idea of where the fund stands. So we've added a little bit of additional information to the purpose of the investment philosophy, again, giving it a little bit more granularity. But the first area we would focus on is Section 4, which says strategic objective, and it's Section D. Just by way of background, the previous benchmark, there were actually really two benchmarks that were utilized by the fund. One was a median private equity benchmark that was used. You know, we always talk about top quartile, we talk about median. It was a median private equity benchmark. The second benchmark was a public benchmark with an illiquidity premium added to it. It was the Russell 3000 plus 500 basis points. The recommendation we'd like to make to the board is really twofold. So one is we've removed the private equity benchmark. The challenge with the private equity benchmark, and we've talked about it in many of the meetings, is that the information, because it is a self-reporting benchmark, the quality of the information within the benchmark is very, very inconsistent. So when you look at it, again, if you have a good performing fund, you may report the information. If it's an underperforming fund, you might not report the information. So we thought it was more prudent to utilize the public benchmark, which is really the trend that many of the pension funds are using. The second part here, when we looked at it, we felt that when we talked to Stepstone, I'll give you a little bit more detail about this, that the private equity benchmark, the way we make private equity returns, we report private equity returns, is with a quarter lag. So really what you're seeing is the valuation from a previous quarter plus all the cash flows from that quarter. So to compare apples to apples, we're using the Russell 3000 with a quarter lag, and then we're adding this 300 basis points of illiquidity premium. And with that, we actually have a little presentation that we can give, which gives a little bit more background of what the marketplace is looking at. And while I will hand that out now, Tom will
go through the presentation. We're going to wait till that. Pass these down. Great, thank you. So we've recommended that the Fire Pension Fund Private Equity Program revise the long-term private equity performance benchmark to the Russell 3000 with one quarter lag plus 300 basis points. This recommendation is consistent with provisions that are being implemented in similar plans, pension plans that have private equity portfolio, and certainly among many of the plans that Stepstone advises. The current private equity investment policy statement was proposed and adopted, as you know, in September of 2003. The performance objective was to outperform the 10-year average of the Russell 3000 plus 500 basis points at that time. The Russell 3000, you may know, is a barometer of about 3,000 U.S. companies, which represents approximately 98% of the investable U.S. markets. And StepStone believes this index provides for the best performance proxy for the fire pension fund. The additional spread over that proxy can be thought of in two components, which Barry mentioned. One is the liquidity risk premium that we think ought to be considered, and then the outperformance of the private equity managers that you all would invest in underlying those. So since implementation of the 2003 IPS, there have been a number of changes that we think suggest a need to reassess the targeted spread over the Russell 3000. Shifts since 2003 include contraction in public market performance, and importantly, increased competition in private equity with more diversity and more capital inflows that have driven overall returns down. In other words, the broader private equity market has become more efficient. In addition, and also importantly, the construction of the fire pension portfolio has shifted with those market dynamics. Over the last 9 years, public market performance has contracted. The market dynamics have generated a lower yield environment. The Russell 3000 8-year historical return has declined by 520 basis points between 2003 and 2011. 10-year Treasury yields have also decreased by approximately 240 basis points since 2003. And it sounds simple, but deterioration of public market performance implies a lower valuation of liquid securities. Because markets are correlated, private equity markets have changed as well over this time period. Competition has increased the amount of capital, and the number of general partners that raise private equity funds has increased dramatically over that time period. And with that, a degree of market efficiency has reduced overall returns for the broad private equity market. Just to highlight some of those changes, from 2000 to 2003, private equity fundraising totaled $588 billion, averaging $147 billion per year. From 2004 to 2011, that number went to $2.1 trillion of raised capital, averaging $268 billion a year. So that's an 82% increase versus the 2000 to 2003 time period, which demonstrates that increased competition by virtue of capital inflow into the asset class. And significant also to this discussion, in 2000, the venture capital sector accounted for over 54% of capital raised in the broader private equity markets. And important to that statistic and relevant to benchmarking is that venture capital garners a higher liquidity risk premium over the public markets relative to other private equity subsectors. To further that point on slide, if you flip to the next slide, slide 6, we've highlighted on the next slide that venture capital and buyout strategies have different return profiles. Venture capital funds are characterized by high loss ratios, which they seek to offset by investing in one or two outsized winners. So those are the Facebooks and the Googles of the world that tend to drive a disproportionate amount of return in venture capital. Venture funds, as you may know, had very strong returns early in the mid-1990s. Top quartile performance for venture funds over the 94 to 2003 time period averaged 28% and consistently exceeded 40% before 1998. The technology market peaked in 2000, as many of you know, which had an adverse impact on the venture market in the late 1990s and 2000s, and the number of VC firms has been dramatically reduced. As you can see from the graph on the bottom of the slide, in terms of number of funds, it just falls off a relative cliff. Now, if you look at slide 7, buyout funds typically produce a much lower loss ratio compared to venture capital funds. So we think buyout funds could be described as a steadier or more consistent return profile strategy, certainly when when compared to venture. Buyout funds are really where returns are delivered through singles and doubles as opposed to swinging for the fences that you get when you invest in venture capital, which may produce outsized returns, but again, there's going to be a much higher loss ratio. And even within buyout funds per se, there's some variability in returns between smaller funds and larger funds. The focus on larger funds minimizes exposure to potentially very large losses, but also takes away from upside optionability. We're striving, as you know, to invest the fire pension funds in the top quartile performers, which are illustrated in the graphs on the bottom of slide 8 there. And lastly, and I think very important to the discussion on benchmarking on slide 9, the fire pension portfolio has changed in size and construction over the past 10-plus years. The portfolio has grown in size and annual commitments since the implementation of that 2003 IPS. The system continues now to make larger commitments targeting managers with larger fund sizes. Since inception, the fire pension has committed over $1 billion to private equity. Approximately 70% of those commitments have been made in the last year. And whereas from 98 to 2004, commitments averaged $35 million per annum, but this has increased more than threefold to $115 million between 2005 and 2011. Also, the strategic allocation mix has shifted since the early 2000 timeframe, and strategies which demanded that higher liquidity risk premiums, such as venture capital, are currently being de-emphasized, therefore driving down the liquidity risk premium that you will require in a benchmark. Given that evolution, both in the asset class and the program, we would recommend changing the benchmark consistent with what Barry had mentioned at the onset of the discussion, to the Russell 3000 with a quarter lag plus 300 basis points, as opposed to the prior benchmarking, which was the Russell 3000 plus 500 basis points.
And we should be clear that this doesn't change the underwriting standard when funds are being recommended to the board.
That's correct, because we're still trying to invest, as I mentioned earlier, in the top quartile, the best performing managers.
So this is a reporting metric, not an underwriting metric, so we think that's important. As we continue to go through the policy statement, if we go to page 70, section 5, what we tried to do here is recommend some more granularity. You know, the way the original policy statement was set up is there were really 4 categories. So there was buyout, there was venture, there was distress, and there was other. As private equity continues to evolve, and more importantly, your portfolio continues to evolve, we thought it was prudent to recommend to the board to give a little bit more granularity in the strategy so you get a better idea of where your dollars are invested. It is important to note that in the previous policy statement, there were actually allocations in the policy statement. The recommendation that we make today is to exclude those asset allocations within private equity strategies in the policy statement, but to put them in the annual tactical plan. So you get the ability, although you could review both, but this hasn't been reviewed since 2003, this idea of the tactical plan, which is done on an annual basis, you get more granularity, you can review it every year, and you can make more tactical changes. We actually have a handout to talk a little bit about that, but we'll do that in the executive session when we discuss the annual tactical plan. With that, we have a couple final comments, which is if you go to section 6, which is on page 73. It's the second bullet point under section, from the bottom under section C. On a quarterly basis, again, StepStone provides the board's quarterly updates on what's happening in the marketplace, the portfolio, and so forth. We also make a recommendation to the board to include there what we would call a compliance or a risk update, which is if they're based on the policies that the board has, that if we've exercised any of those policies, so if there have been any opt-outs or things like that, on a quarterly basis, you find out what they are. So we thought that was something that was prudent to do. Last couple items would be if you go to page 74. Section D, under investment guidelines. Number 2, co-investment in direct secondaries. What we thought was also important to recommend to the boards is to have, for lack of a better term, more tools in the toolbox, to give you all more flexibility. So the way the previous policy statement had been set up, you really didn't have the flexibility to do direct co-investments and to do direct secondaries. You had the ability to do them in a fund structure, but not as a, for lack of a better term, a co-investment. It's important to note here that this is not making a recommendation to the board asking for discretion. Ultimately, the decision-making process on this is you all. But what we thought was important was to give you the flexibility to make that decision, as opposed to before, if an opportunity came up, it would have been against what the policy statement said here. So here it's just giving you more flexibility, giving you more opportunity, and as more capital is committed into the asset class, we just thought it was prudent and made more sense. And the last 2 items are exceptions to the policy statement, so which is Section E. While the policy statement talked a lot about things you could do and things you couldn't do, in essence, there was no remedy. So there was, okay, so if something happened and went against the policy statement, what was the reporting? How did you do it? That was never included in there, so we thought we'd give it more granularity on reporting back to the boards if there was an exception to the policy statement. And finally, Section 9, risk management. Section C, as Tom had touched on before, as the retirement system or the fire pension fund has grown in size, and the amount of dollars you've deployed into the private equity asset class has grown, we felt it was prudent to increase the bookends on the amount of dollars you invest in a fund, because again, you have a larger denominator. So investing $5 million in a fund when the size of your fund was a couple $1 billion was very different. So again, it's important to note that we continue to make recommendations to the board on individual funds, but we've grown the bookends, or made a recommendation to grow the bookends, the amount of dollars you invest. And with that, those are the kind of the salient points on the recommendations we have for the board on modifications to the policy statement. And with that, we leave it open if there are any questions and so forth. Mr. North.
Yeah, if I may, on the issue of benchmarking, first, and maybe it's my mathematics that isn't quite right here, but by lowering the expected additional return, the excess return, to 3% from 5%, doesn't this potentially put the asset class into a position of actually having lower Sharpe ratios and information ratios than if you just levered up the Russell 3000, i.e. we're going through a lot of work and effort to get excess returns that could be gotten, in theory, on an expected basis, much more cheaply and easily. Have you done those calculations? Have I just done them wrong? Or, I mean, NEPC probably has expected long-term returns on private equity versus the Russell 3000, and variability of returns versus the Russell 3000, and it should be relatively easy to determine. But it seems that when one is reducing the future expectation, that there's a lot of cost to go into this asset class, and it isn't just the amount that's paid to the managers. It's the overall risk-reward profile of the class, and I hope that you have, in fact, reviewed that and concluded that the class still makes sense in light of this proposed change in the expected returns.
Well, we do think that the asset class still makes sense. We think that as long as it is done appropriately and you're investing in the best managers that you possibly can, which is the work that we try and do for the pension plan. Creating benchmarks is a bit both art and science, and we are trying to be consistent with changes that happen both within the asset class and within the plan itself. The changes that we're recommending, as I mentioned, are consistent sort of across the board in the world that we live in with other pension plans that are similar to the fire pension plan in nature.
I think it's also important to note, as we touched on before, one thing that Tom had said, which is one, if you look at the variability of risk, or you look at venture. So if you look at the legacy portfolio today, there's a significant amount of venture in the entire portfolio. Today, we're not looking to make recommendations to the boards on venture. But more importantly, I think the key here, and this is a reporting metric, so it's not the underwriting metric that we're using and StepStone is using when recommending a fund to the board. we are still using a top quartile or a top decile benchmark. And I did touch on before, the quality of the information is a challenge. But the way it's set up today is that if we're recommending a buyout fund, we are using a buyout metric. If we are recommending a secondary fund, we're using a secondary fund metric. And I think that's important. So it's a peer comparison. So the idea here is to recommend the best and the brightest, so the top quartile or the top decile. But this is a reporting metric. This is not the underwriting metric. And it is always a challenge. As Tom said very eloquently, there's a little bit of art in here. And ultimately, I think what's important here is that as we continue to develop and evolve the policy statement, while if it is approved, it would be written in stone, but that being said, it can be changed.
I would just like on that issue of seeking top quartile funds, I know when the board first adopted the investment policy to include private equity, the concept was to seek out top quartile funds, that the range of returns based on private equity managers was very wide and success depended on getting the best. I believe your presentation suggests that due to the competition in the market, et cetera, the types of funds that FIRE is investing in, that range of variability amongst private equity managers has shrunk somewhat and could be expected to be less. I also presume that this has nothing to do with how much managers get paid. As you said, the underwriting criteria stay the same. But I always get concerned when it appears that the benchmark is seeking less than it did in the past, because on a risk-reward basis, there's a lot to this, and it raises, as I say, in my mind, the question of whether or not it really is truly going to meet the characteristics, even though it's generally a good asset class for long-lived investments, and you all can afford the illiquidity. So those are just a couple of questions I want to ask on it. I did want to ask about the 1/4 lag. I presume that, and I think this has always been done, that the way you're measuring this is you're basically just aligning the cash flows with if it had gone in the Russell 3000 versus if it had gone in. The 1-year lag is all about just... the 1/4 lag is just about the fact that the data reporting is behind.
Correct.
And you're just trying to get it so you can put the numbers
More
down.
apples to apples,
And so the 1/4 lag is just getting us from the most recently available private equity data and bringing it forward on a closest comparable as possible basis. Okay, that wasn't originally that clear to me. Finally, I do have, after all this discussion about risk and reward and appropriateness, just a techie thing on page... Where is it? It's page 74 in the book, under E number 2, where you talked about urgent matters. I thought it was an excellent addition, but you just may want to update right at the very end, a documented phone vote. You talked about possibly doing electronics, and I would just suggest you remove the term phone and just a documented vote, because you talk about possibly doing an electronic vote. So that's my 2 cents on it. But I would appreciate if NEPC or the Bureau of Asset Managers, Stepstone, could do a little, provide some information on this risk-reward relationship now between the asset class on its expected benchmark versus the Russell 3000 as a benchmark. Just to see that the relationship after the adjustment for risk means that the asset class, although it has diversifying properties and other good things, is really getting the bang for the buck that all the work involved in doing it justifies.
Yeah, just maybe respond to a couple of points you made. So the first is I would say that the recommendation is consistent with the way that we think about modeling private equity, and we're trying to model it like we do the public markets and capture the beta, if you will, of the market and not have an assumption about alpha. And so the beta that we're capturing is that illiquidity premium over the public markets. And right now we're using 2.5%. So when we're modeling it, I think what we always tell clients is that in a mean variance framework, which is part of the discussion we have about policy, and we have that asset allocation policy discussion, private equity is the one of the categories that does not necessarily fit well into a mean variance framework, because you've got the highest expected return, and the volatility number is essentially partially reflective of what you perceive as the risk, but also the fact that the valuation framework in private markets means that you're going to have less volatility in some environments, even though there's a lot of variability in the outcome of manager selection. So there's a couple of things we're trying to track, and I try to capture, and I agree it's more art than science with the volatility number. So what do? We assign it the highest volatility number commensurate with the return, and then the correlation number is going to drive how it fits in the portfolio. We still see private equity as a very attractive risk-return trade-off. We share some of the concerns of staff and StepStone about the capital flowing in impacting the opportunity set. To your point about levering the Russell 2000, we don't subscribe to the idea that you can create a synthetic private equity exposure. And if we want to have a discussion about leverage, I'm happy to have that on a number of fronts in your policy portfolio, but I think that's a much broader discussion. When you go to the private equity markets, you're accessing a different opportunity set, right? Different companies, smaller companies, emerging companies, and we don't think you can effectively capture that synthetically by trying to, lever the Russell 2000 or lever certain sectors in the Russell 2000 or anything like that. I have seen, those kind of ideas surface once in a while, but I don't consider them strong.
Just like to clarify two things. If I misspoke, I meant the Russell 3000.
Russell 3, sorry.
And second, with respect to this overall levering, I really was only talking about the risk-reward relationship.
Okay.
Personally, I think, like you, I believe a big public fund can find a way to do an asset allocation without getting into a lot of synthetic leveraging and so on and so forth. Of course, we do have hedge funds and other things floating around in the portfolio that do some of that.
Yeah.
But that's just to clarify my point. My point was about the risk reward. You said a 2.5% adjustment on the beta side. I was looking at it when I did a couple of my own numbers of something a little more than that, which is what raised the question of, is +3 the right benchmark? And finally, I just want to say, I've always believed that just because that's what everybody else does is not the best reason to pick it. It still might be the right thing to do, but it has to be justified on other more critical bases than just we're being like everybody else.
Well, so I'd add a couple more points. One, so private equity is one of the harder categories to benchmark. So I don't hear Barry saying, don't look at the peer groups and the other stuff. I just hear him saying, for the policy, let's focus on a public market benchmark. Oh, by the way, it's easier to use that in the policy framework when we do attribution on the total fund, right? And we'll still look at the peer group stuff because it's important to look at it for the total portfolio and for individual categories or managers. And then, lastly, on the IRR or the use of it in the calculation. So for the BNY Mellon reports, you're going to see the Russell 3 time-weighted, and you're going to see in the StepStone stuff, they do a cash flow weighted Russell 3 plus the 300. So they're essentially saying as your cash comes in or goes in or comes out of the private equity portfolio or individual strategies, you're going to see them capturing that as a benchmark for all the pieces of your private equity portfolio.
Yeah, that part I like very much.
So I think that works well.
It's a consistent comparison that is better in some ways than most of the other asset classes, but most of the other asset classes that are mature, time-weighted versus dollar-weighted returns don't make that much of a difference. Here, historically, it has, and this is being done what I think is the right way. And I think that the addition of trying to find a way to make it more up-to-date and consistent with the problem of the lag is an improvement in the analysis.
Yeah, and it's still, and candidly, it's still a problem with the BNY reports and our reports when we do the total fund attribution, because we've got to figure out a way to kind of capture that as best as possible, because we've increasingly, 5 years ago, when your private equity portfolio was less than 3% of your portfolio, it doesn't make as much of a difference as it does when it creeps up to 7%. We want to make sure it's captured if we're having those attribution discussions when we do the annual review or what have you.
I should have also mentioned that when in tandem with putting this recommendation together, it incorporates both Stepstone's and NEPC's comments. I should have mentioned that before.
No, it's fine.
Could I ask a clarifying or confirmation question from Stepstone on one thing? So you acknowledge that because of more competition and greater efficiency that, the liquidity premium, as you call it, has dropped from 500 to 300 basis points. Now, is it...
It's just part of the one component of why we're...
Yeah, and plus VC being a smaller component. But, is it safe for me to assume that that's just strictly the market...
Broader markets,
yes. Like the beta spread.
Yes.
So on top of that, there's going to be, assuming our managers are top quartile, there's going to be some alpha.
Yes.
But it's probably safe to assume that, versus 2003, the alpha expectation's gone down too, just because there's more competition, or would you say it's pretty comparable?
I'd say it's pretty comparable because there are certain strategies, and given the market environment, there's still opportunities from which to create alpha. So we still think it's there, but it may be a little bit harder to find because there's a preponderance of capital in the asset class that was smaller, 10 years ago.
So what would you, if you had to put a target, a figure for that alpha goal, what would it be, over the next 10 years? What do you think is realistic?
Well, I think we're trying, for the blended portfolio, blended private equity portfolio, we're trying to generate sort of 20 plus IRR and get as close to 2 times your money as possible.
Gross or net 20?
That's
Gross
gross.
or net?
That's gross.
Gross, right, okay. What's net then?
High teens to...
15?
15,
Yeah.
16 is a good...
Okay.
15, 16, if that number comes in, we're in better shape.
Now, one of the problems with our portfolio when you're benchmarking it, and Barry has the numbers, is you're lugging around a lot of old assets that are below the benchmark. And we could have a big conversation about how we should look at things, but there's a chunk of assets that's 29%, 29% that we're not going to get our money back on. So there's a drag on the portfolio that's going to make it so this benchmark isn't met for, 4 years, 3 years, because the bad stuff has to run off to be replaced with the good stuff. And we tried some of that with the secondary sale, so we did some of it, but there's a bunch of stuff in here that's just, it's a drag on the overall portfolio that we're replacing with new stuff that they can then get committed to, then invested in. So again, if 27% is not returning capital, the remaining 63% is at least positive, and then we've increased our allocation, and we've hopefully increased it with better funds. But there's a drag on the portfolio that you just really can't get rid of.
Okay, thanks.
But that doesn't have anything to do with our benchmark. That's just a fact.
It's a fact.
But if I might ask, though, the getting rid of the Thompson or one of the private equity benchmarks, do you have something, given that the 10-year has a lot of other stuff in it, the historical, what do you do on a quarter-to-quarter, more like year-to-year basis to be comfortable that the emerging portfolio is keeping up with expectations? Is there any statistical way? Because if the private equity benchmarks, as bad as they might be, say that the average private equity portfolio went up 5% in the year, isn't there some value to having something like that, as if not in the investment policy statement, at least somewhere in the analysis?
Well, we can have just to interject a minute. We can do lots of analysis. We've done lots of analysis, and it depends on what you're looking for. So, for instance, you can look at how our portfolio is doing by vintage year, right? So we've got some years right and some years wrong. That's one way of looking at it, because it's relative. although, our portfolio picked up in '06, '07, '08, so the prior year is probably too small a sample, A. B, we've made some decisions to sort of de-emphasize, say, venture capital. You can slice that out if you want and say, well, that was interesting, but don't confuse that with what the new things are, so you can say, all right, forget that. You can also then slice out the stuff that we're not going to re-up with or we haven't re-up with, and you can put those two things in something called legacy portfolio and track that. You can track that relative to your keeper portfolio, your keeper and your new. So, for instance, if we were a company, you might, if you were a new management team, come in and say, you know what, let's have a discontinued item that's called the runoff portfolio and track that separately. But let's not confuse that with the stuff that we like and the stuff that we're going to build in the future. You can watch one go down and run off, sort of like Citigroup did, and you can watch the rest go on. Now, the reality is we own it all. But if you're trying to track performance of staff and board and Stepstone, I would tell you you're supposed to somewhere along the way say, bright line in the sand, let's see how your plan's doing. That's not a strategy, but that's sort of the annual plan review might slice it so that you're not always making excuses saying, well, it's the old portfolio, because it's interesting, it's the old portfolio, but who cares? We want to know about how we doing this quarter, next quarter, the quarter after, the year after. And we've looked at that, and, the bad portfolio, or not the bad portfolio, I don't mean to call it that, the bottom. There's a bottom of everything, right? There's a bottom of U.S. equity, there's a bottom of real estate, there's a bottom of everything we do. But I would tell you strategically the right question, or a question is, are we fixing it? Are we changing it? And is that value added? As opposed to smushing it all together and saying you're always stuck with the old stuff and you can't ever get rid of it. I'd say somewhere along the way you're supposed to say, okay, show us both ways. I'm not going to make excuses, but show us both ways so that we can get our head around that we're doing it better or doing it worse. And if we're doing it worse, well, for God's sakes, change that, right? But there are ways to do it.
I guess that's my point. You do intend to continue producing vintage year numbers.
Yes.
Do comparisons against the general benchmarks as well as the whatever we've got here, so that one can see how the portfolio evolves over time by its individual components. And if that's all available, then I think that answers my question to more than sufficiently.
We have it. We tend not to burden boards with it because that's how we track how we're doing. That's an internal BAM thing to make sure that because again, we set out with a goal citywide. When you add up all the funds, we're trying to put out $2.5 to $3 billion a year in private equity, and you have to have, if that's your target, where's it going? What's the annual plan? So then we come to you with the annual plan for fire is this slice, and then we'll make sure that the performance is tracking. But we do that. One of the problems in something as intricate as private equity is if you look at the reporting package back here in this book, the monthly book, it's a bunch of goop, right? It's not very informative, which is why we have the Stepstone quarterly report, which tries to be more informative. And then you get down to your question, Bob, it's too granular, right? You're always going to pull yourself back up, but this is a very granular thing that we're trying to not get lost in the weeds, but we, BAM, have to pay attention to every weed possible so that it adds up to the right answer. So I would almost say what we ought to do is, because it would involve a detailed discussion of managers, I would say once a year we should do a deep dive on an asset class like private equity and real estate, where there's a lot of managers to talk through, but the board should kind of go through that so that it knows who's actually doing well and who's actually not. Again, it's in the Stepstone quarterly report, but that also focuses on top 10. We have 168 funds, so top 10 might be interesting, but not enough, right? So it's a delicate dance as to when is too much, when is too little, but I would say strategically, you have to make sure that the annual plans are actually being implemented and then tracked for the quality. Because again, you can execute the annual plan, but it's the wrong annual plan. That wasn't very good either. So That's a very long-winded way to say we should come back to you once a year or twice a year with
We'll show you what we have.
deeper dive.
Yeah, and I'm a big fan of having the board deal with policy issues.
Right.
And I think that your suggestion is a big picture and not necessarily even worrying about every individual investment. There's always going to be some, unless there's a policy level question to be answered, actually need come to the board. But a good solid annual overview of where we are, which is the annual plan plus, really should do the job. I'm just concerned in this whole benchmarking area that, like almost every asset class, the more money that gets into it, the less likelihood of being able to make good excess returns. To the extent you're only getting beta, except for diversification and correlation, it isn't worth going into another asset class, and that those things should just be part of the big picture discussion and be part of the justification for continuing whatever's done. Other than absolutely giving everybody and you a hard time here today, I think that the policy statement looks pretty good.
Let me give you one quick comment on leveraging the S&P versus private equity, or the Russell 3. It's the asset class where you actually have real active management of companies. So it's different than just leveraging passive. And we could spend a lot of time on that, but the bottom line is it's the active after you own it that they create their alpha.
Selection.
Right.
Understood. And I was using it more as a risk reward, just a proxy for it. And you're right, there's a lot of flaws to try and, they're not the same thing.
Right, they're not the same thing.
Diversification issue and the other reasons for being there. But I think as part of the overall, what are your alternatives at the policy level if you've got a risk-reward profile that doesn't hold up versus other asset classes? You may still want it purely for diversification, but it just should be part of the factored-in analysis. So I'm sorry I've taken so long, so much of your time, but I think if you're going to adopt the policy, you just want to make sure that it's talked about and you're comfortable with the changes that are being made. And I had these issues, and hopefully it's acceptable to the board to have listened.
The world's a safer place now that we had that discussion.
So with that, we'd ask if there are any additional questions, Janice.
First, I want to say thank you for all of the hard work that Bayonne and Stepstone have done in updating this policy. I think it looks great, so thank you for doing that. At the last meeting, I had asked for a little bit of education for us with regard to the changes in the sectors that are being proposed. So do you have that prepared?
So we have that for the executive session in tandem with the tactical plan.
Can we do it now so that we can approve the policy before we get to the tactical plan?
It's the tactical plan.
Yeah.
They're different things.
Two different things.
I'm actually asking about the sectors on page 2 of the new policy. So we've got a new sector for energy that we really haven't discussed as a board in the past.
Well, it's important to know, when you look at the way the previous policy statement was set up, is that there are energy investments in the fund.
Right.
They were all grouped into buyout. So buyout was 60 to 80%. So we're not recommending different sectors. We're recommending more granularity on the reporting of those sectors. And the idea of the tactical plan, which we plan on discussing in the executive session, actually we have another handout which talks a little bit about the granularity. So it is important to note that it's not a new recommendation of strategy, it's just granularity in reporting.
There is a change, and you did go through for us today, thank you, the reason for taking venture out and having that category just be growth. So that's terrific. And then tell me about special situations turnaround.
So that's actually just, we called it distress. That's what it was in the policy statement. So this is just a rebranding.
Okay, well that makes sense. And then the other question that I have that's related to the sectors, and I understand the reason that you've taken out the policy ranges, the long-term strategic policy ranges, in awareness of the fact that the board doesn't often review this this statement. It does review the annual tactical plan, so I understand where you're coming from with regard to that. But one of the major reasons you have a policy statement for a particular asset class is to define the risk expectations for the program. And in our previous policy, the way the board defined its risk expectations for the program was to have these long-term strategic ranges. So how do you propose then that we can better define what our expectations ought to be for risk now that we've taken this out of our policy? What can we include in our policy that does define what sort of risk we expect to take in this program?
Well, one of the things when we looked at that and we talked with Stepstone, we thought one of the challenges was, again, and you touched on it before, which was the policy dates back to 2003. And this idea of return expectations, whether you think something is a long-term asset class, a medium-term, or a short-term, 9 years is probably an extended period of time to review it. So we thought the opportunity here made more sense that under the policy statement, there's this discussion about the strategic or tactical plan, which will be done on an annual basis. So being able to do it on an annual basis, again, we think enables the board to get a better understanding of what the risk or what the recommendations or tolerance would be. But more importantly, again, if we go back to the way the policy statement was set up before, it was a broad-based range where majority of the money was focused towards buyout. And buyout is the largest sector. And again, there's more detail for the executive session. But we think it's more prudent when you're looking at this, again, this is a long-term asset class, but to understand the ranges and review them on an annual basis. And there may, in fact, be no changes on an annual basis, because as Larry has touched on before, and I think we've all touched on before, is that private equity fundraising, you're either in the market or not in the market. So it's a little bit lumpy. And the reality of the situation is that we want to recommend to the boards the best managers that are not necessarily available today, but the best managers that are out there in private equity, which is why one of the things we do is we have this forward-looking calendar. And that enables us to get a better idea of who's in the market and who we want to recommend to you all. Because again, there is a allocation to the asset class. That money doesn't have to be committed. If we say that there is a certain target, if there are not the best and the brightest private equity managers available during that period, we will look to utilize that for the next period. So we think understanding the strategy from a risk standpoint or understanding what the market is very important. But we do believe that when it gets reviewed, reviewing it on an annual basis is just a more prudent way to invest. And again, there may not be changes on an annual basis, but at least it creates this opportunity to review it on an annual basis.
Agreed, absolutely.
I think part of the problem is when you try to put ranges on this, it's a little bit like there's another IPS that we have that has huge ranges. And it's sort of like, what was the point of that?
Right.
It goes 0 to 50% of this and 0 to 25% of that. So you could drive a truck through it, but I think it gives a false sense of accuracy. Whereas these annual plans are pretty damn granular now the way we have them.
So how do you suggest we can, so the annual plan defines what our strategy is for the short term. How can we put something in either this policy or our broad policy statement so that we understand what our risk expectations are for the very long term for this asset class? Could we perhaps, for example, put in what the standard deviation expectation was when we developed our asset allocation? I'm just looking for a way to put something in a policy statement that's a long-term document just to define what our long-term risk expectations are. And I don't know if NEPC has any suggestions based on what other clients might do.
I think we have, I'll defer to you as to how you do it. We have, not in this statement, but we have a very thorough asset allocation analysis that we did when we did the asset allocation that has risk in it. I don't know what you do with that. We all have it. But that has risk by asset class, expected return.
But that's not part of the policy statement.
No, it's not part of the policy, but that was a decision we made. That's the only thing that actually has a risk and a number.
Yeah, I mean, so there's absolute risk measures and relative risk measures. And in the case of private equity, I don't think you have great numbers or data for either. And so most of our clients, I don't know that any of the clients I work with that use, even in their quarterly reporting, any kind of risk measures to capture the private equity volatility or any kind of other relative risk measures like tracking error versus some kind of policy. You definitely have to have a more mature portfolio to even try to do that with a composite return stream. So I don't know that there's any good answer for you on something that we could measure and put in a policy and feel good about. I haven't seen any risk data on any of the Cambridge or Thomson 1 return streams or peer groups, so I don't know that there are any that we could use.
I think we would agree with you.
Is it fair to say that today most of your clients, Tom, do have ranges in their policy statements for the asset classes that they invest in?
I'd say it's a mix. I can't say it depends on the client.
I'm sorry, would you repeat that again?
It depends on the client. There's a mix.
Why don't you look at the specificity in the annual plan? You can always attach an annual plan to your policy statement.
Right, but again, that's a short-term risk versus long-term risk that we would put into a policy. So I'm just asking for, for ideas for what other clients are doing that can help us better define risk.
We can come back to you with some other ideas, some clients, but it is a mix, so I don't know that I have a specific answer because it depends on client to client.
And
We'll come
then
back to you.
Another risk-related question. How are we defining the type of currency risk we want to take in this portfolio now that we are starting to invest outside of the U.S.?
So,
How are we controlling that or defining it?
so currency is not incorporated into the policy statement. What I think we would say is with regards to specific and allocation with regards to currency, that falls more into the overall fund. It's not a private equity issue per se. We talk about geography in here, but we don't talk about actual currency.
We actually don't think we address it in the total policy, the broad policy either.
No, there's a section in the general IPS about currency.
Yeah, but it doesn't address currency risk and the type of currency risk exposures we're comfortable with as a board. So that's just
I
another.
mean, it is on page 7 here. It talks about currency. It says that we don't really, it says it's policy, we don't hedge.
We don't hedge.
Right, so that's the policy the board has adopted not to hedge currency in private equity. So as far as the 4x4 of this IPS, it says we're not hedging it.
But we don't have any controls that say we could be perhaps 80% in non-dollar private equity investments and 20% in U.S. dollar.
No, we look at it, we keep track of it, but every time we do, we've looked at it recently because we've made some reasonable size commitments to European funds. It sort of becomes de minimis inside the whole fund.
And just getting back to defining what the board expects in terms of risk, might we say we're limiting non-dollar exposure in the private equity program to whatever percent the board feels comfortable with, whether that's
I think the board's
20%
not.
or 30%.
I think the board's not doing that. There's nothing in here that says the board's limiting non-dollar.
Yeah, and that's, I guess, my point, is that one of the purposes of an investment policy statement is to define what type of risk the board wants to take in the program. And so we're not currently giving any guidance in terms of how much we want to have in non-dollar investments.
I think that's not, I think it's, you're looking at it a little backwards. I think the board is giving guidance by not restricting it.
Larry, you said to do an allocation, I thought you said it would be de minimis.
It is. I mean, we have probably $1 billion.
Now we're talking about
Citywide.
in the aggregate.
Yeah.
So
Citywide, we probably have $1 billion of euro-denominated private equity out of $130 billion.
So less than 1%.
So less than 1% is euro-denominated. So less than 1% of the fire portfolio, private equity, is euro-denominated.
And we don't really expect that to change.
No, we keep track of it, just so that we know, and we actually worry about it and say, well, are we supposed to talk about it and talk about currency? And if you look at the plan for the year, which we'll go through later, looking at currency hedging is one of the things that we're thinking of looking at as we move the entire portfolio more globally.
What would sort of light you up in terms of that? What would be the movement on the euro side, for instance, that would really concern you?
For private equity, or for the whole thing?
Yeah.
For private equity, the problem with private equity and currency is how to hedge it. So say we make a $10 million commitment to a European fund. It's euros. We don't need any euros day one. It's just a commitment. So if then they send us a drawdown notice 6 months later, say we want 1 million of your 10 million. We go out in the market on that day and buy our $1 million. You could hedge that. That's hedging your cost. We don't know when we're going to get that $1 million back when they sell their asset in 3 years, 5 years, 7 years. So you can't actually hedge that going forward because you don't know when it's coming back. If you try to hedge it, per se, you say, well, we think we'll get the money back in 5 years. If they give it back to you in 3 years, you now have a timing problem on your hedge. So you're not really well hedged. So you kind of look at the portfolio and say, well, we got a bunch of these things now going on. Isn't there some level that's small where we should just go out and assume we're just going to have euro exposure? And again, in the big IPS, the boards have decided not to hedge it. So there's no big overlay that says, look, if I parse through real estate with a little bit of euro exposure, private equity, IFA, maybe our public stocks are bouncing around in euros, they would go out and buy some. It's pretty hard to come up with the answer as to what it is you're actually trying to hedge. So the boards have decided, don't worry about it. Rightly or wrongly, the board decided not to worry about it. Everything else will correct itself.
So I think based on what Larry just said, it sounds like about 15% of the outstanding commitments may be in non-dollar of the private equity portfolio, round numbers?
I'd say it's less. It's probably closer to 10.
So 10 to 15%. So I think if you're going to have a conversation about currency risk, we should start it with the international equity and emerging markets portfolios, because you already have 15% plus of your total plan in foreign currency exposure there. Call it maybe 5% to the euro, and the emerging currencies we would argue you should leave unhedged. But I think that's where the currency discussion should start. The private equity, I agree with Larry. It's you've got a drawdown structure, a timing issue. The hedging costs alone, I think, would kind of make it potentially not worth doing if you try to do shorter hedges and then layer them on as you have drawdowns build out. You still have to worry about your gains and your losses and that impacting the hedging process. So I think if you're going to talk about currency risk, we should do it in the context of the asset allocation discussion and focus on the public markets first.
And I know we're in the process of updating our broad policy, so let's just put that as an item to address.
I wrote it down actually on my list.
So you'll come back to us then with some solutions on defining risk in the program?
Well, I think we're going to come back and have the discussion about what kind of language framework we should have, and then what kind of data we should be looking at when we do have the policy discussion. Or when we have, even if we're just updating the policy discussion, we don't necessarily anticipate a lot of changes, that's where we can introduce that data and have the conversation about that source of risk.
Okay. So talking about the risk of the various asset classes in the broad policy, as opposed to in the individual asset class policy, seems like a good solution.
Okay. So, do we take Bob's little comment on phone versus?
I wrote that down.
Yeah? Okay, so subject to that, because that was a verbal, something we can all track, we'd like a motion to approve this IPS, so we can be done with this IPS.
So moved.
Second. Any objections? Hearing none, the motion passes.
Thank you. That ends our agenda for the public session.
Okay, we need a motion to move out of the public session and move into executive session.
So moved.
Is there a second?
Second.
Any objections? Hearing none, the motion passes. We're in executive session.